Welcome to IPTM. Today we're doing a special deep dive. Think of us as your personal guide through a really comprehensive payroll classroom summary. This one was led by the payroll expert, Mr. Ajit. Our mission here, it's simple. We want to take all that information and make it crystal clear for you, the learner. So whether you're just starting out in payroll or maybe you're looking to, really solidify your understanding, we're here to pull out the core nuggets of wisdom. We want to help you clearly understand what was covered in that session and also, importantly, explore some fantastic learning opportunities for your career. Because payroll, well, it's not just about paying people, is it? It's more like navigating this complex maze of legal and financial rules. Today, we're basically giving you the map. We're distilling the essential stuff, the foundations you need to turn that maze into a path you can walk confidently. We'll be getting into company compliance, tax essentials, and even some really powerful automation tools later on.
Yeah. And what's really fascinating, I think, is how all these pieces fit together. You might think corporate law over here, Excel functions over there. They seem separate.
Yeah.
But actually, they all intrinsically build up this robust framework, the framework you need for accurate, compliant, and honestly strategic payroll.
Yeah.
It's all deeply interconnected. Understanding that connection, that's kind of your secret weapon in this field.
Absolutely. That interconnectedness is key. So let's unpack this, starting right at the beginning. Before we even think about cutting a check for an employee, we need to understand the company itself, right? The entity doing the employing. The session kicked off with some crucial insights there. Company incorporation, compliance. Where do we start with those foundational bits?
Right. The absolute starting point, the ground floor, if you like, is the Ministry of Corporate Affairs, the MCA. They're the main regulator for companies and LLPs. That's limited liability partnerships here in India. Their job essentially is promoting good governance, sure, but also making it easier to actually do business. And one big way they've done that is with SPICE plus goal. What used to be, well, a bit of a fragmented process with different forms, like MCA Form 1 for incorporation, name reservation separate. It's now all streamlined. It's in this single comprehensive web-based application, SPICE plus all.
Okay, SPICE plus off. That sounds like a huge improvement. What exactly does it bundle together? And maybe more importantly for someone in payroll, what's the practical impact of making it so streamlined?
Well, it's pretty revolutionary, honestly. SPICE Plus integrates almost everything you need initially. Name reservation, the actual company incorporation itself, getting the director identification numbers, the DINs for up to 3 directors, applying for the company's PAN and TAN, registering for mandatory things like EPFO and ESIC, Provident Fund and employee state insurance. And it even helps get the bank account opened, all through one interface. So the practical impact, it's not just fewer forms. It means you, in payroll, can onboard a new company and its first employees much, much faster. You get them compliant right from day one with way less administrative headache. It's about speed and accuracy right from the start.
That efficiency sounds critical, especially early on. You mentioned directors and DNs. Directors are obviously key figures. What are their main roles and, crucially, responsibilities that directly touch the world of payroll?
Well, directors are designated as key managerial personnel under the Companies Act, 2013. That comes with significant responsibility. They have a fiduciary duty, meaning they have to act in the company's best interest. They need to exercise care and diligence, avoid conflicts of interest, oversee the company's finances, and, crucially, ensure absolute compliance with all relevant laws. That absolutely includes tax laws and labor laws affecting payroll. So their oversight directly impacts payroll because it ensures the company is operating legally and, can actually pay its employees correctly and on time. If there's negligence on their part, it can lead to some pretty serious civil or even criminal liabilities, and that directly jeopardizes the company's ability to function and meet payroll.
Makes sense. And navigating all this, especially the filings, requires specific digital tools or credentials, right? What are the absolute must-haves there?
Precisely. The first one is the Digital Signature Certificate, or DSC. This isn't just a file, it's a secure digital key. It has the same legal weight as your handwritten signature that's under the IT Act of 2000. You absolutely need it for almost all MCA filings, plus e-filing tax returns, GST stuff, Provident Fund submissions. It ensures authenticity and security online. Then there's the Director Identification Number, the DIN. That's a mandatory unique 10-digit ID. The MCA assigns it to anyone who intends to be a director. You get it either through that SPICE Plus form when setting up a new company, or via Form DIR3 if it's for an existing company or more directors. It's a lifetime ID, and the rule is strictly 1 DIN per person. These aren't just bureaucratic hoops. They're fundamental for digital identity and accountability in company management.
Okay, got it. So once you have the company set up, directors identified, DSC and DIN sorted, how does the type of company matter? Private versus public limited. How does that actually change things for a payroll professional day to day?
That distinction is huge for compliance. A private limited company needs at least 2 members, max 200, and minimum 2 directors. Share transfers are restricted. Their name ends in private limited. Public companies, often just called limited, need minimum 7 members, no upper limit on members, and at least 3 directors. Their shares, freely transferable. And they can raise money from the public. So for you in payroll, the big takeaway is that public companies, especially if they're listed on a stock exchange, face much, much stricter corporate governance rules. That translates directly into a heavier compliance burden. Think more complex reporting, more rigorous audits, more disclosures needed for payroll data.
And that higher level of scrutiny, that's where organizations like SEBI come into play, right? The regulators for the public markets.
Exactly. SEBI, the Securities and Exchange Board of India, is the main regulator for India's securities market. Their primary goal is protecting investors, yes, but they also heavily regulate the companies issuing securities, like through an IPO, an initial public offering, and the market intermediaries. So for a payroll pro, understanding SEBI means knowing that for public companies, particularly those listed on exchanges like the NSE or BSE, after going through that whole demanding IPO process, the level of scrutiny on all financial reporting, definitely including your payroll data, just goes through the roof. It means your data accuracy, your audit trails, sticking to governance standards. It's not just good practice anymore. It's absolutely non-negotiable. It affects how you structure compensation, how you report it, everything.
Right. So just to circle back and hammer this home, why is all this company level stuff, the incorporation, the director duties, the company type, why is it so fundamental for someone really diving into payroll?
It's paramount. It's absolutely paramount because payroll doesn't exist in a vacuum. It operates entirely within the company's specific legal and compliance framework. So many rules, like when certain labor laws kick in, think ESI Act applying once you hit 10 employees in specific areas, are directly tied to the company's status, its size, its structure. And fundamentally, the director's ability to ensure compliance impacts the company's very license to operate, and critically, its ability to pay its people correctly and legally. It's not just interesting background info, it's the absolute bedrock. You build accurate, compliant payroll on top of this understanding.
Okay, that lays a really solid foundation on the corporate side. Now let's shift gears a bit. We need to talk about the rules that govern, well, pretty much every financial transaction within that company, the legal and tax framework. This is where things get really interesting, I think, for payroll professionals day to day. The session got into the nuts and bolts of how laws are actually made in India and the different kinds of taxes we deal with.
Indeed. Lawmaking in India, it's a structured process. You've got Parliament, which means the Lok Sabha, the House of the People, and the Rajya Sabha, the Council of States. And of course, the President's assent is vital. Now, there are different types of bills, but for us in payroll, our radar is always tuned to one specific thing. The finance bill. This is the main financial bill type that comes out of the annual union budget. Why does it matter so much? Because it directly changes our tax rules. Tax slabs, deductions, exemptions. Everything that impacts an employee's take-home pay is usually defined or tweaked in the finance bill. Understanding a bit about its journey, like it has to start in the Lok Sabha, needs the President's okay beforehand, and the Rajya Sabha has limited power to change it the lover. It gives you insight into how a tax landscape gets reshaped each year. There are the bills, sure, but the finance bill. That's your annual guidepost for payroll calculations.
Right, the finance bill is key. So once these laws, especially the tax laws, are enacted, how do they translate into the actual taxes we pay or manage? What's that core difference between direct and indirect taxes, and why is that distinction important for payroll?
Good question. Taxes in India fall into 2 main buckets, direct and indirect. Direct taxes, they think income tax, which is our main focus, and corporate tax are levied directly on income or wealth. The defining feature. The burden can't be shifted. The person or entity earning the income pays the tax and bears the financial hit. These are generally progressive, meaning higher income often means a higher tax rate. And for payroll professionals, direct taxes, specifically income tax deducted from salaries, that's your bread and butter. That's what you calculate and manage daily. Indirect taxes, on the other hand, like GST, goods and services tax, or customs duty, are levied on goods or services. The key difference here is the burden can be shifted. A manufacturer pays GST, sure, but they typically pass that cost on to the consumer in the price. So the impact falls on someone different from the person initially paying the tax. They tend to be regressive.
That makes perfect sense. Payroll, primarily direct taxes. Okay. So focusing on direct taxes, what are the essential timeframes we absolutely need to get right? You hear terms like FY and AY thrown around.
Yes, absolutely fundamental. The two key terms are the financial year, or FY, and the assessment year, or AY. The financial year is simply the 12-month period when income is earned. In India, that's consistently April 1st to March 31st of the next calendar year. Legally, this is also sometimes called the previous year. The assessment year is the 12-month period that follows immediately after the financial year. It also runs April 1st to March 31st. This is the year when the income earned during the previous FY is assessed, meaning calculated and taxed. So, simple example, income you earned between April 1st, 2024 and March 31st, 2025, that's FY 2024-25, gets assessed and taxed in the period from April 1st, 2025 to March 31st, 2026, that's AY 2025-26. Getting this distinction right is critical for all your compliance deadlines, tax filings, and reporting cycles. It dictates the rhythm of the tax year.
Got it. FY for earning, AY for assessing. Now, who exactly are we assessing? Does the tax law see everyone the same, or are there different categories of persons or taxpayers we need to know about?
Oh, no. The Income Tax Act definitely recognizes different types of entities as persons or taxpayers. Each has slightly different rules. The most common one is obviously the individual. That's straightforward. But then you have Hindu undivided families, or HEFs, which are unique family units treated as separate taxable entities. Then there are companies, taxed at specific corporate rates. You've got firms, which covers both traditional partnership firms and the newer limited liability partnerships, LLPs. There's also Association of Persons, AOP, or Body of Individuals, BOI, basically groups formed for a common purpose, maybe not formally a company or firm. And finally, local authorities like municipal bodies, and a catch-all category called artificial juridical persons for entities that don't fit elsewhere, like maybe a university or a deity in some contexts. Why does this matter for payroll? Because each type of person can have slightly different compliance rules or tax treatments associated with them, even impacting things related to their employees sometimes. You need to know who you're dealing with.
Okay, different taxpayer types. Now, this connects to something you often hear about, which sounds really important, residential status. How does where someone lives, tax-wise, fit into all this?
Residential status is absolutely critical. It's maybe one of those crucial factors because it determines the scope of income that's taxable in India for that person. And note, it's different from citizenship. For an individual, there are basically three statuses we need to understand. First, resident and ordinarily resident, or ORR. If you fall into this category, you're taxed in India on your global income. Doesn't matter where you earned it. If you're an ROR, it's potentially taxable here. Getting this status usually means meeting a basic condition, like being in India for 182 days or more in the FY, and meeting two additional conditions related to your residency over the previous years. Second is resident, but not ordinarily resident, or RNOR. You get this status if you meet a basic condition but don't meet one or both of the additional conditions. An RNOR pays tax in India on income earned or received here, plus any foreign income from a business controlled from India or a profession set up here. Other foreign income is generally off the hook. And third, non-resident, or NR. This is if you don't meet the basic conditions for residency.
An NR is only taxed in India on income that's received here or accrues or arises here. Income earned and received outside India generally isn't taxed here, even if from an Indian-controlled business. Getting this status right is paramount for payroll, especially with global mobility, people moving in and out. Misclassifying someone's residential status can lead to major tax errors, both for the employee and for the company as the deductor.
Wow, okay. That really highlights the complexity, doesn't it? And this is exactly where, as you said earlier, the core of payroll really comes alive for you, the learner. So let's zoom right in now on what payroll professionals grapple with every single day. Calculating income tax on salary payments. The session really dug deep into this.
He did, yes. And the foundation for all of this is the Income Tax Act, 1961. As we touched on, it gets updated every year through the Finance Act that comes out of the budget. Its aims are broad revenue, economic regulation, wealth redistribution, preventing evasion. But for us, it provides the specific rules. The Act famously categorizes all income under 5 main heads of income. But for payroll, our laser focus, just like in the session, is squarely on income from salary.
Okay, income from salary. How do we actually get to that taxable figure? Can you walk us through that step-by-step calculation process?
Sure, it's a methodical process. Let's break it down. Step 1, determine the gross salary. This is the total of everything: basic pay, allowances like HRA, transport allowance, any special allowances, perquisites, which are non-cash benefits like company car or accommodation, bonuses, commissions, everything. Step 2, identify and subtract any exemptions allowed under the Act. A really common one, and one with its own calculation, is house rent allowance, HRA. The exempt amount for HRA is the lowest of 3 things. 1, the actual HRA the employer paid you. 2, 40% of your salary, basic plus DA, or 50% if you live in a metro city like Delhi, Mumbai, Chennai, Kolkata. Or 3, the actual rent you paid minus 10% of your salary, basic plus DA. You calculate all three, pick the smallest, and that's your HRA exemption. Step 3, deduct the standard deduction. This is a flat amount. Under the old tax regime, it's currently €50,000. Now, a key update from the union budget 2025-26 for the new regime, this standard deduction is now $75,000 if you opt for the new regime. Okay, so after you subtract exemptions and the standard deduction from gross salary, what you're left with is your income from salary.
Right. Gross salary minus exemptions minus standard deduction gives us income from salary. What happens next?
Well, if the individual has income from other sources, maybe interest from savings accounts or fixed deposits, that gets added here. That gives you the gross total income, GTI. Step 5. From GTI, you then subtract deductions allowed under Chapter 6A of the Income Tax Act. These are the popular tax-saving investments and expenditures. The most famous one is Section 80C. This allows deductions up to a limit of $1.5 lakh per year for things like contributions to Public Provident Fund, PPF, equity-linked savings schemes, ELSS, mutual funds, life insurance premiums, repayment of the principal part of a home loan, kids' tuition fees, and more. Another important one is Section 80D for health insurance premiums you can claim for yourself, your spouse, kids, and also separately for parents. There's also Section 24B for interest paid on a home loan, which can be a significant deduction. So after you subtract all eligible Chapter 6AA deductions from the gross total income, you finally arrive at the net taxable income. Step 6. Apply the income tax rates. This is where the tax slabs come in. You apply the rates based on whether the person chose the old or new regime. Step 7. Calculate any final adjustments. This includes the rebate under Section 87A, which reduces tax liability for lower income earners. There might be a surcharge if the income is very high. And finally, everyone pays the health and education cess, which is currently 4% calculated on the total income tax plus surcharge. That gives you the final tax payable.
Wow. Okay. That's a detailed process. And you mentioned the old versus new tax regimes. That's a big decision point for employees, isn't it? It can be confusing.
It absolutely can be. Let's clarify that choice. The old regime, the traditional one, generally has higher tax slab rates. But its big advantage is that it allows you to claim a wide range of deductions and exemptions like that Section 80C we talked about, HRA exemption, home loan interest under 24B, and others. The new regime, which is now the default option if an employee doesn't choose, generally offers lower tax slab rates. But the trade-off is that most of those common deductions and exemptions are not available. However, the Union Budget 2025-26 made some significant changes to make the new regime more appealing. They increased the income threshold for the tax rebate under Section 87A. This means for resident individuals opting for the new regime, income up to 12 lakh is now effectively tax-free. That's a big jump. Plus, they reintroduced, or rather increased, the standard deduction to $75,000 zalazan, specifically for those under the new regime as well. So which one should someone choose? It really boils down to their individual financial situation. If someone makes significant investments in things like ADC, pays a lot of home loan interest, or has high HRA, the old regime might still be better.
If they don't have many deductions, the lower rates and higher tax-free limit of the new regime might save them more. You really have to calculate it both ways. And quickly on TDS tax deducted at source. For regular salary payments, the employer estimates the total annual tax liability based on the chosen regime and deductions declared, then divides that by the number of remaining months of the financial year to deduct tax proportionally each month. But for one-time payments, like a large annual bonus, the tax impact is usually calculated, and the entire additional tax due on that bonus is deducted in the month the bonus is paid. It's not spread out.
That's a really clear explanation. Let's try to make it even more concrete for you, the listener, with a quick, simplified example. Let's take someone, say, Mr. A. Imagine his gross salary is $8,000 for the year. Let's say under the old regime, he gets an HRA exemption calculated at $50,000. He also gets the standard deduction of $50,000. So euro 1,000 minus 50,000 HRA minus euro 50,000 standard deduction. That brings his income from salary down to $7,000. Now, let's say he's made full use of Section 80C, investing over $50,000, and he also paid $15,000 in health insurance premium, eligible under Section 80D. So his total Chapter VORA deductions are $1,050,000 plus $15,000 plus $15,000, euro 1,065,000. We subtract that from his $7,000 income from salary. So $7,000 minus $165,000 gives a net taxable income of $5,035,000. Applying the old regime slabs to this $5,035,000. Well, the first $2.5 is tax-free. The next euro 2.5 from 2.5 to 5 is taxed at 5%, which is $12,500. The remaining $35,000 from 5 to 5.35 is taxed at 20%, which is $7,000. So his basic tax is $12,500 plus €7,000, $19,500. He'd also get a rebate under 87A since his income is just over 5L. but let's ignore that for simplicity. Add the 4% cess on 19,500 euro, which is 780 euro. His total tax payable for the year would be around 20,280. See how all those steps we discussed, gross salary, exemptions, deductions, slabs, cess, all come together? It directly determines that final tax number. Okay, theory and calculations covered. Now let's shift to the practical tools. Payroll involves handling a lot of data, and making mistakes is easy. The session highlighted some incredibly useful tools, starting with something most of us have access to, Excel.
Oh, absolutely. Excel is it's still a powerhouse for payroll, especially for data preparation and basic automation. The session focused on some key text functions first. These are vital for cleaning up messy data, which you often get from HR systems or timesheets. Think about upper or lower, simple, but great for standardizing names or codes so they match across different files. Then you have mid, left, and right. These are fantastic for pulling out specific pieces of information from a text string, like extracting an employee code from a longer ID or maybe a department code. Clean is another lifesaver. It removes those weird non-printable characters that sometimes sneak into data when you import it, which can cause errors later. And Lin helps you check if, say, all PAN numbers have the correct length. Mastering these text functions means you can take raw, inconsistent data and whip it into shape quickly and accurately. That saves a ton of manual work and prevents errors downstream.
Right, cleaning data is step one. What about functions for calculations and logic?
Yeah, but the session covered key ones there too. eDice is probably the most fundamental logical function. You use it constantly for conditional calculations, like if sales target met, then calculate bonus this way, else calculate it that way. Or maybe if employee category is X, then apply Y allowance. It automates decisions based on criteria. Round is essential. Financial data needs precision. You need to round calculations to 2 decimal places usually, and round ensures that accuracy. Don't rely on just formatting. Date dive is a bit of a hidden gem, actually. It's great for calculating durations between 2 dates like employee age or years of service for gratuity calculations or maybe long service awards. It can give you the result in years, months, or days. Very useful. Row can be handy for generating sequential serial numbers in reports or tables, especially dynamic ones. And Texty is great for formatting numbers or dates exactly how you want them as text. This is useful if you need to concatenate numbers into a text string for a report, or format dates in a specific way, like DDMMIY.
Okay, so mastering these functions gives you a solid toolkit. This is where that practical skill really complements the theoretical knowledge, right? Making it real for you, the learner. What about setting up Excel for even more automation?
Exactly. It's about building on these basics. The session also touched on preparing Excel for more advanced stuff, things like creating custom lists. If you frequently type the same list of departments or job titles, making a custom list speeds up data entry and ensures consistency. Enabling macros and ActiveX controls is crucial if you want to start using or developing VBA scripts for automation. You need to adjust Excel security settings for that. Adding the Developer tab to your Excel ribbon is necessary too. That's where you access the tools for macros, VBA, and inserting controls. And finally, installing the Power Pivot add-in was strongly recommended. Power Pivot lets you handle much larger data sets than standard Excel, create sophisticated data models, and perform powerful analysis. It really sets the stage for serious data handling and automation in payroll. It makes your whole operation more scalable.
That's great practical advice. So we've covered company setup, law, tax calculations, Excel tools. Bringing it all together after this really comprehensive deep dive, what does this all actually mean for you, the listener, and your career path in payroll?
Well, mastering these concepts, both the theory and the practical application, it really does open doors. It's not just about being a payroll processor anymore. You can move into specialized payroll consulting, helping companies set up or optimize their systems, or HRMS testing, making sure the software actually handles all these complex Indian payroll rules correctly. Even areas like content creation, writing articles, creating training materials in the payroll domain become possibilities because you have that deep understanding. The session really emphasized the need for practice, actively studying the tax laws, especially after the budget each year, practicing those Excel formulas until they become second nature, regularly reviewing things like PAN validation rules or the nuances of residential status, and, interestingly, leveraging modern AI tools, using things like ChatGPT or Gemini for, say, smart note-taking during learning, quickly researching a specific compliance point, or even drafting standard employee communications about tax changes. It's about using all the tools available.
That emphasis on continuous learning seems really critical here.
It is. Payroll is anything but static. Look at the changes we just discussed from the union budget 2025-26. Every year, there are changes. Tax laws evolve. Compliance rules get updated. That means systems need updating. Processes need tweaking, and your knowledge has to keep pace. You have to be committed to continuous learning in this field. But that constant evolution is also what makes it challenging and, I think, quite rewarding. So maybe here's a thought to leave you with. What if truly mastering these foundational payroll and compliance concepts isn't just about getting the numbers right, about achieving accuracy? What if it's actually about unlocking strategic value for the company? By ensuring compliance, optimizing processes, providing accurate data for decision-making, you become an indispensable asset. You move beyond just processing payroll to contributing strategically in a business landscape that increasingly demands precision, compliance, and real efficiency.
That's a really powerful thought. Becoming a strategic asset, not just a processor. If you're feeling inspired and looking for live sessions or perhaps more personal guidance to continue building these skills, do check out the upcoming IPTM courses and consider joining live training. And if you liked this deep dive video and want to continue learning, please don't wait. Watch the next video now and keep building your knowledge. Keep learning something new. Happy learning. Thank you.